Good afternoon, everybody, and welcome to the Fat Profits macro webinar today. Patrick Ganley will moderate with Angus Geddes. Angus, how are you today?
Yeah, good, thanks, Pat.
Good, and welcome to all the members. We've got quite a bit to talk about today, so we'll just get through our normal housekeeping items. Your presenters, both Angus and Patrick, today, and we'll get going. Disclaimer: all information provided today is on a general advice basis. Before acting on any of the information or recommendations, please be sure to consult with a financial advisor before doing so, and please be reminded that past performance is no indication of future returns. You will be able to ask some questions. Angus and I will endeavor to get through them. You can type your questions in where the orange arrow is and submit them to us. If for some reason you can't hear the presentation, a couple of things you might want to look at is check the volume on your PC, check the speakers are plugged in, check your headphones, check the sound settings. And if you're still having issues, please give us a call at the office, 1-300-88-1177, and we'll try to help you out. So without further ado, Fat Profits market update. Angus, it's been an interesting time with the markets, and I thought we'd start with this S&P 500.
Yeah, so the S&P 500, there's been a lot going on, Pat, as you know, in the markets since I've been away. And I think, look, probably the most obvious thing is we're just seeing the S&P 500 continually make new record highs. It's continued to grind higher. And I think, you know, it's really due to a confluence of factors. We've got inflation that's trending down. We've got the backdrop of the US economy being very solid, very strong. We've got a very resilient labour market, you know, as evidenced by that blowout sort of non-farm payrolls number a week or so ago. And in essence, you know, what we're really looking at is a no landing scenario. So no recession is really sort of on the horizon or likely over the near term. We're going into third quarter earnings, and as I sort of noted this morning in my note, I think investors are increasingly upbeat about how the reporting season is going to go. And, you know, given we've got this strong economic backdrop. So, you know, I suppose near term, you know, a risk is the US election, which is really looking like it's going to be a photo finish between the Democrats and the Republicans. It could go either way. But putting that aside, you know, I think it's pretty clear sailing for the market into the end of the year, particularly if we get a low CPI print tomorrow, and I think we will get that, and which will confirm that disinflationary trend. One factor that has changed, you know, in the last several weeks is I think we're on for just 25 basis points of easing this year. I don't think we're going to get a 50. I don't think we'll get 2 cuts of 25 basis points, but perhaps just 1. And you know, given that the economic backdrop is so strong, but I don't think that's going to stop the market. And you know, and if anything, you know, the bond market really is beginning to behave a lot more optimistically. You know, I was a little bit worried the fact that those bond yields were so low at the long end of the curve. You know, and that sort of said to me that the stock market didn't see a recession, but the bond market saw risks of a recession. I think those risks have now receded with the rise in the long end of the yield curve. So all in all, you know, I think things are looking pretty good. And on top of that, you know, we've had this sort of unprecedented monetary stimulus by the Chinese government. We're going to talk a bit more about that on the webinar later in this session. But I think that's very encouraging, and it says to me that, you know, Beijing has now turned a corner. They are now committed to putting a floor underneath China's economy and turning that around. And I think we're seeing that come through now in the stock market. That's beginning to see that as well. in terms of that domestic stock market. So, yeah, I think, look, bottom line, there's a lot to be encouraged about looking into the end of the year. And let's not forget Australia either. You know, I'm sticking to our base case that we'll see the first rate cut here before the end of the year. You know, when I took my publishing break, we had that benign CPI print in Australia, which, you know, like every other country around the world, we're now seeing inflation coming down at quite a rapid pace, which is paving the way for rate cuts. And we saw that in New Zealand this week. You know, there was another outsized 50 basis point rate cut by the RBNZ that came through. I think that was yesterday. So that's all pretty positive. And I think, you know, before too long, we'll be getting rate cuts, you know, here in Australia. So, yeah, pretty encouraged by the macro backdrop. And I think, you know, we're on course to get a pretty strong finish by global stock markets into the end of the year.
Okay, so the Federal Reserve seems to be comfortable where inflation's trending at the moment, and as you just said, you think we'll probably get another 25 basis point drop before the end of the year, and then maybe a bit more in early 2025. Is that your thinking?
I think so. You know, the labour market was strong, so I think that means that the Fed will probably take it a bit less aggressively in terms of bringing interest rates down. But I definitely see another 25 basis point cut before the end of the year, and potentially, you know, 75 to 100 basis points of easing next year. I don't think anything is going to change that, you know, unless, of course, we sort of see inflationary pressures reassert to the top side. But, you know, that's not the base case at the moment.
Okay, you touched earlier on the U.S. 10-year bond, and I thought this was an interesting chart that you wanted to talk about today.
Yeah, so I was a little bit concerned about the bond market a few weeks ago, and that, you know, when the 10-year yield got down to 3.6%, you wouldn't really expect that if you were going into a soft landing, no landing scenario, no recession. What you really want to see is the yield curve disinverting and having a positive slope with near-term rates lower than long-term rates. And I think we're beginning to see that now. You know, the 10 years well above not well above, but it's above the 5-year. And, you know, I think as the Fed cuts, we'll see that short end begin to really fall away over the next 6 months, which is really what we want to see. And it's really the bond market endorsing a no landing, no recession scenario. So I think we're sort of seeing that at the moment. There's nothing about this chart and the technical setup on the 10-year that sort of says to me that the yield is going to run away on the top side. You know, it would be worrying, you know, if we saw the 10-year run back to 5%, for example, but I don't see that happening. We've had a series of lower highs and lower lows since that peak above 5.1% was made back in 2023, which is what we want to see. So, you know, I don't see the 10-year yield getting much above 4.2. I think it's going to hit quite a lot of resistance at that level. And what this sort of says to me is that the US economy, you know, continues to be in very strong rudimentary health with no recession on the horizon.
Okay, and if we turn to the US dollar index, I mean, this is something that you and I have been talking quite a bit about, is the US dollar and where it's heading at this point in time.
Well, I'm probably a bit of a lone wolf on this one, but I think the US dollar is showing signs of being as sick as a parrot, really. You know, we've had multiple tests of this 100 level and a series of lower reaction highs. You know, in terms of where the dollar index is at the moment, it's sort of hitting up against that 103 resistance level. And I think it will be difficult for the dollar index to go much above that level. And I think this sets the greenback up for the dollar index up for another retest of that big support level. And if we're right, inflation continues to come down, that's going to pave the way really for the Fed to continue to ease. Those interest rate differentials are going to continue to narrow between the US and the rest of the world. I think the Fed's going to bring rates down faster than most other central banks. And then the other side of it really is, I think we've got structural weakness coming in the form of, we've still got quite proliferate sort of government fiscal spending over there, regardless of who wins in November. The US government is going to continue to spend money. The US national debt is going to continue to grow at a sizable clip. And I think this sort of sets the US dollar up for a fall below that 101 level sometime in the next 6 months. And of course, what's negative for the US dollar is going to be positive for the commodities complex and also those emerging markets. And I think, notably China and Hong Kong, which we're going to talk a little bit about later on.
Okay, so the setup's still looking good, positive for gold at this point in time?
Yeah, I think so. We've seen very little volatility in gold, despite this recent rally in the dollar index, which bounced off that sort of 100 level. It's rallied 3%, but we haven't seen much of a pullback in gold at all. And we're seeing silver and some of those other precious metals holding very well. So yeah, I'm continue to be bullish on the precious metals and the precious metal miners, which as we've sort of been emphasising, Pat, in recent months, they're underowned as an asset class, and we've seen some decent outperformance in the sector. Some of the Australian gold stocks have done well, as have the international gold stocks. So I think we're going to continue to see some outperformance there, particularly with most investors very underrepresented in the sector in that asset class. And if we're right on the dollar coming back down to test that 100 level, a break below 100 on the dollar index could really set the precious metals up for a very strong couple of quarters.
And we've seen the gold price hit record highs, but again, I know you and I have spoken about this before. A lot of the gold producers here in Australia just really haven't caught up. Do you think we'll see that?
I think so, yeah. That's my view. We're seeing a little bit of corporate activity pick up. So obviously the miners are looking at each other and going, well, you're cheap, I'm going to bid for you. It's cheaper to buy an existing operation and bring a brownfields mine into production. So I think that's going to continue, and I think it's really only a matter of time before we do get that catch up. We have seen, some catch up. Some of the Aussie miners that we like, such as Northern Star and Evolution Mining, are up near their sort of 4-year highs, 4 or 5 year highs. So yeah, I think it's going to continue, and I'll be looking for new record highs in a lot of those precious metal miners next year.
And some of them be spitting off a lot of cash at the moment, wouldn't they?
They certainly are, and there's a very strong argument that a lot of these boards should be signing off on big buyback programs, not going out and buying more mines, but aggressively buying back their own shares while valuations are cheap. So I think we will see more of that.
Okay, and I know you ran this image today in your daily note, and it's quite an interesting one by Sir John Templeton.
Yeah, I mean, it was just interesting. We've been bullish on China, Hong Kong equities for some time, and you know, while I was on my publishing break, you know, we had this explosive move. Hong Kong surged 50% plus from those, well, not Hong Kong actually, but I guess what I'm trying to say is Hong Kong had a huge move. It was a 35-40% plus move from the August lows, as did China, the CSI 300. And, you know, whilst I was away, the CSI 300 confirmed a topside inflection, and in my opinion, a complete exit from that bear market, that really severe bear market that's been weighing on that market for a number of years now. So yeah, I think, look, both of these stock markets have inflected. We saw quite a nasty drop yesterday, and of course a lot of media airwaves and the business press questioning the sustainability of the rally. You know, that's all typical behaviour, and I thought it was worth sort of quoting Sir John Templeton. You know, the time of maximum pessimism is the best time to buy. And I think we've certainly seen that. You know, bull markets are born on pessimism, not on optimism. They start at a point of maximum pessimism, and I think that's certainly true to say as it relates to China, Hong Kong shares. And I think, you know, that bull market is in a very early stage. It's going to climb a wall of worry. But I think, you know, we've seen a remarkable change and attitude from the Chinese government. We're due to hear from the finance minister on Saturday, and it's my view that more fiscal stimulus is coming down the line, and that they are determined now to put a floor under the property market and the economy, and they want to see things turn around pretty quickly.
So do you think yesterday was just a bit of uncertainty around the stimulus? Because I know you're talking about Saturday. They're going to come out with a bit more information on this.
Oh, look, I think, you know, whenever you get a 35-40% upward move in the space of a week or so, you're going to get a correction on the other side. So, you know, if anything, I'd be looking to buy into any weakness in coming days. I suppose the risks for the bears and those of the short is that the government comes out all guns blazing on Saturday with a huge fiscal stimulus package that surprises the market. You know, there's always a risk that they will underjuice the stimulus on Saturday, but I don't think this changes anything in terms of our view that, you know, the CSI 300 and the Hang Seng are in new bull markets. I mean, valuations are still very cheap. You know, as the crow flies today, you know, both of those markets are priced at about 10 times in terms of the forward PE. So, you know, if anything, you know, and I've been saying this for a while, the cumulative measures are all going to add up, and I think we're sort of seeing that coming through. We're sort of seeing green shoots coming through in the property market, which is looking a lot better. And you know, if anything, we're going to see the earnings growth start to come through next year. And of course, stock markets are discounting machines. They look into the future. They look where the economy's not where the economy is today, but where it's going to be in 12 months. So, you know, the technical setup in terms of where the economy's going and what the government's doing in terms of stimulus, I think that's a game changer. And, you know, if anything, we're now in new bull markets for Hong Kong, China equities. And I think there's value to be had there. And I think the risk reward skew is favourable. The technical setup is particularly bullish. And whilst, you know, we might see a bit of consolidation after those huge moves over the last few weeks, the path of least resistance is now on the top side.
So looking at this chart, I mean, that's a pretty significant move, isn't it?
It is. Yeah, that is what I would call a defining technical breakout. You know, we had a successful test of the double bottom, and I was quite vocal about that, quite, you know, mentioned that on many occasions in recent months, and now we've had the breakout. So yeah, it's as good as it gets, and I don't think China, Hong Kong equities are going into a bear market anytime soon. I think that's yesterday's story. Tomorrow's story is the new bull market and where the economy will be in 12 months. I think, yeah, we're looking at much better times ahead for China. And of course, what's good for China is good for Australia. I think we've seen some important inflections, a lot of those base metals and some of the diversified resource stocks. I think, they sort of came under pressure when investors were concerned about where China's economy was headed. But of course, if they come out with a fiscal stimulus, what's good for China's economy is going to be great for Australia as well.
Okay, and you spoke a little bit earlier about some of the big moves in Hong Kong, and here's another chart that looks pretty impressive at the moment with the move here.
Yeah, it's almost identical to the CSI 300. Hong Kong actually confirmed an exit from that bear market and that primary downward trend months before China did. But now China has confirmed as well. And, I think with the Hang Seng, there's a wall of support below 20,000. I don't think it's going to go below that level. We will see some nice consolidation and, like the CSI 300, once that consolidation is out of the way, and depending on, what the Chinese government does Saturday and then coming weeks and months, I think both of these indexes reassert to the top side to challenge the 22 highs. In the case of the Hang Seng, I think we'll see a retest of 23,000 within 3 to 6 months, and then an upside extension above that.
Okay, I wanted to ask you a question. I mean, Warren Buffett's sitting on a stockpile of cash. Where do you think he's looking to deploy his cash? In the U.S., or do you think it's...
Can we move to the next slide? Yeah.
Yep. Stocks and...
Actually, I ran the Nikkei and the Topex this morning. It's daily, so I just want to reference that. I think both of those indexes are priming for another upward move to the top side. And yeah, it was interesting talking about Warren Buffett sitting on this huge cash pile, and the fact that Berkshire Hathaway is now raising a whole lot of funding in Japan. So, Warren Buffett doesn't like taking foreign exchange risk. By funding in local currency and buying local stocks, he's essentially got a natural hedge against the FX exchange rate. So in other words, he's not taking on FX risk by swapping dollars for yen, and then having that FX exposure. He's funding an asset with yen. So in other words, what I think is going to be interesting is what Warren Buffett is going to buy. I don't think it's a question of if he's going to buy anything in Japan. I just think it's a case of when we find out what he's been buying. And, is he going to add to some of those trading houses that he's made a lot of money on in the last few years, or is he going to diversify his Japanese book and start diversifying into other sectors? It wouldn't surprise me if he's looking closely at those Japanese banks and the insurance companies, which sell for very low price to book multiples. They've all demonstrating quite solid earnings growth. You've got rising interest rates over there, which is a natural tailwind for the banks and for the insurance companies. So it wouldn't surprise me if in a couple of months we find out that Berkshire Hathaway's been buying in that sector. Regardless, I think it's a big endorsement for Japan. The world's savviest investor is stepping up his commitment in Japan. It just sort of says to me that they're very comfortable with what they've been doing over there, and it's really an endorsement also, of what we've been doing in Japan as well, Patrick. As you know, we've had quite a lot of Japanese exposure within our portfolios for some time, and I still see a very favourable upside risk skew there, especially now that a lot of that short yen carry trade has been unwound. which induced all that volatility a couple of months ago. And I think we're well and truly through that. So, if anything, better days lie ahead for Japan.
Okay, now we'll head into some stocks that I know you wanted to talk about, and we'll start with this one here. I know you've spoken about this numerous times, and you like this stock.
Well, Alibaba's a bellwether, one of the largest tech companies in China, currently priced at about 10 times forward earnings. The stock is still 75%, 2/3 down from where it traded at its record high back in 2020. And this technical setup confirms an exit from the primary downtrend, and and that an inflection is underway. And we might see a little bit more consolidation between 100 and sort of 120, but I think once we break out above 120, it's off to the races for Alibaba. I think that will confirm an inflection, and we've got scope for a significant recovery in the years ahead. And this is a bellwether Chinese technology stock, one of the largest companies, lots of cash on the balance sheet, lots of potential there for them to launch buybacks, etc. And I think we're going to get a decent turnaround and inflection and back to growth in coming years as China gets back on a growth footing.
Okay, and the second stock we wanted to talk about is Tencent Holdings.
Tencent has confirmed a topside inflection in recent weeks. This is another stock that we hold on our portfolios, and the path of least resistance is to the top side. So I'd expect now that this inflection is in for Tencent to retest those record highs sometime over the coming year or coming years. I think there's excellent upside potential here. Tencent, like Alibaba, very clean balance sheet, very strong balance sheet, not much debt, lots of cash on the balance sheet, and it's growing top line revenue in double-digit figures. So there's a lot to be excited about Tencent Holdings. And if there's sort of any more weakness in the China stock market, I'd be putting this stock into the portfolio.
Okay, and our third stock, this is another one that I know you're quite interested in.
Yeah, this is the one of the major technology companies. Meituan sort of specializes in food delivery platforms, online retailing, etc. So it's a major player in that space, and like sort of Alibaba, it's well down from those record highs back in 2020 when the stock got up to nearly 500 Hong Kong dollars a share. And again, it's confirmed this big inflection with the breakout above 140 in recent weeks. So this would be another stock that we own in our portfolios, and I'd be adding to on weakness.
Okay, and we spoke earlier a little bit about China, the stimulus package coming out. And as you said, what's good for China is probably good for Australia. So here we've got BHP, and we've seen some action in this stock recently.
Yeah, we were pretty vocal about our view on the resources sector and the fact that iron ore would find a floor, strong support under $90 or below, and that BHP and Rio would not break down below these big primary uptrends that have been in place since 2016. So we've seen the big upward dynamic come through in BHP, and obviously that's coincided with the turnaround in China, the launch of the monetary policy stimulus, and the sort of collective view that the Chinese government are determined now to turn around their economy. What's good for China has got to be good for BHP. And I think this move back and towards the midpoint of the range is really encouraging. I like the resources sector, and I think if anything, this is going to provide a big tailwind, not just for the resources sector and commodity prices, but the Australian stock market generally. And we've got a target of sort of 9,000 on the ASX 200 for the end of next year. If we get this lift coming through from the resources sector, which I think is sustainable, and I think it's real. That's going to, make that price target on the ASX 200 quite achievable, I would have thought, next year. So, if anything, BHP, Rio, these stocks can move back to retest their record highs, I think, over the next sort of 6 months as China's economy gets back on its feet.
Okay, so now we'll go to some questions. I wanted to ask you a question about, reporting season kicks off this week with the big banks set to report. How do you see that all playing out?
I think the US reporting season is going to go quite well. We've seen the bar of expectations been lowered a bit. So, analysts are not overly optimistic. And we've got this very strong sort of economic backdrop. So if anything, I think we're going to get a really solid reporting season for September. And then, that's going to, underpin the strength in the market, I think, and that bullish run that we're looking for sort of into the end of the year. So, yeah, looking for a pretty solid September quarter in the US. And I think that will underpin this sort of, bullish sentiments that we've got around the world. And I think it's going to help the ASX, Japan, UK, and certainly I think, Hong Kong and China are now dancing to the sound of their own drum. I think we're going to see quite a strong finish into the end of the year.
Okay, and then with the oil price, with all these tensions going on around the world, how do you see the oil price at the moment?
I think it's actually sitting in quite a good spot at the moment for the world, really, for the global economy. It hasn't run away to the top side. That's keeping a lid on inflation and keeping that disinflationary trend in place. But it hasn't collapsed either. And that's good as well, because we don't want it rolling over in a bad way, because that implies that we could be headed into a recession, or that China's headed into a recession. So I think, on a balance, the oil price is good. And, if anything, I sort of see it heading back to $80, $85 a barrel, which would confirm that, China's doing better and that all is well in the global economy.
Do you think these tensions in the Middle East slow down, or you think it's going to get worse before it gets better?
Well, that is a wild card, and barring unforeseen events, the situation in the Middle East gets massively out of control, and that is a risk. But we haven't seen that happen. I suppose things are deteriorating over there, and we do have to be cognizant of that. We do have to be cognizant of Middle East risks, but we're yet to really see that impact China and Hong Kong and America and Australia at this point. And we're not seeing oil at 110, 120 a barrel. So that is yet to happen. And look, heaven forbid, if the situation did suddenly spiral out of control and something dreadful, unforeseen were to happen, well, we're well hedged with our precious metals. There's just no question that gold would be a significant beneficiary of any unforeseen catastrophe if it were to happen in the Middle East.
I know the States is under pressure right now. They've got that massive hurricane getting ready to rip through the country, which could cause quite a bit of damage over there. Do you think that affects the market in any way?
Look, I think there's upside risk in the oil price, particularly if it were to knock out some of those platforms, those oil producing platforms in the Gulf of Mexico. But we're not really sort of seeing that. We're not really sort of seeing that impact in the energy price. I mean, I don't know what the weather's going to be like. I don't know what the storm's going to be like, Patrick, when it sort of hits landfall in Florida. But these storms are pretty regular. And as always, the market sort of tends to take it within stride. So I think, this time probably, proved to be a similar outcome.
I just wanted to ask you a question. I know you had a break last week. Did you pick up anything interesting in your travels when you're away?
Yeah, it was interesting that that there were a lot of people traveling at that time. I was a bit surprised. I was thinking that, beyond the peak tourist season in the Northern Hemisphere, which, typically finishes in August and people go back to work, I was surprised at the number of people that were traveling and spending money, and the restaurants were all full. So yeah, it was interesting from that perspective. All the flights were absolutely chocker. Coming back from London on Qantas, no surprise that Qantas is trading at 720. There wasn't a spare seat on the plane. And this is not peak season, this is on the shoulder. So I thought that was interesting. And, coming through Singapore, all the duty-free shops were full. People were spending money. When the economy's doing badly in Asia, everything's on sale. Didn't really see too much sign of that this time. So all in all, I think this is supportive of our sort of growth scenario for the next sort of 6 months, and the economy is actually doing quite well. And I think it's going to be interesting in Australia. I've made a point a couple of weeks ago about Solomon Lew, and I thought this was interesting that he talked about the retailing conditions being the toughest in his 61 years in Australia. And we know a lot of the sort of middle of the range retailers, the turnover is well off. I think there's going to be an opportunity in that sector at some point. Some of these sort of stocks that have really been beaten down, in terms of the discretionary retail spending. So I'll be keeping an eye out for that.
Okay, had a question just come through about China, and do you have any ETFs that you think are worth having a look at for playing the Chinese market at the moment?
Yeah, well, as members will know, there's a ETF that we've recommended in Australia, which is the IZZ's the code. The research team, it's the iShares China Large Cap ETF. That gives you a broad range of exposure to large Chinese companies. All those stocks that I've spoken about today on the webinar, they're all key holdings in this exchange traded fund. And it's a way really of diversifying out of stock specific risk and playing the broader market.
Okay, I think that covers it today. We hope all the members enjoyed the presentation today and got some value out of the conversation. Angus, as always, it's a pleasure having a chat with you. It's good to see you back, and we'll sign off and say bye for now.
Bye for now. Thanks, Pat.